Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA N Raja, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India. Worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice. Had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executives. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar.
I'm creating this video based on the query received from a student. While assessing working capital, say cash credit, we arrive at drawing power based on inventory and receivables. Receivables include cost of the product or service, profit, and GST also. So the question is whether the GST on receivables should be considered for arriving at the drawing power or whether it should be excluded. The straightforward answer for this question is it is as per your bank policy. Having said that, let us do a small analysis as to what will be the impact if it is included, if it is excluded. Okay, so I have created a small case. It's a hypothetical scenario. Let's say a particular borrower who has just started the business and this is his first transaction. Okay, assuming there are no other backgrounds. So he is investing money in raw material 50, labor 15, other manufacturing expenses 15. So his total cost is 80. On this total cost, he is adding a profit which is 20. So that makes his selling price as 100. And on this 100, he is adding 18% GST and that makes invoice value as 118. For this invoice 118, how much he has invested actually? He has invested only on these three. That is raw material, labor and other manufacturing expenses. So that's what you see here. Borrower invested rupees 80 and produced this product. And he sold this product to a customer at 60 days credit. It means for next 60 days, he is not going to get back this 80. Not only this 80, he is also not going to get back this estimated profit. He is also not going to get back this GST. Okay. So he has to manage the show for next 60 days and he is approaching you. He is asking funding against receivables. Now the question is, you have to arrive at the eligible bank finance by including the GST in receivables, by excluding the GST in receivables, then compare and contrast. Let's prepare a small cash book to understand what is happening. Here, the borrower has brought in his own fund into the business to the extent of 80. Okay. He used that 80 for purchase of raw material. He used that 80 for labor. He used that 80 for other manufacturing expenses. So that entire 80 has been used. He is cash dry and he wants to run the show for next 60 days. That's why he has approached the bank. Okay. Now this is the scenario before sale. Before sale, he brought in 80, entire 80 was used. And the moment he sold the product, invoice is raised and invoice included GST, right? This was the GST amount. So if he raised the invoice, then he has got the responsibility to pay the GST amount also in the next month. So before sale, this is cash outflow position, and after sale, he is also expected to remit GST to government, but borrower is going to pay only after 60 days on the 60th day, but he has to pay in the next month. And how much he should pay? The 18, what is billed? 18 is billed. But he need not pay entire 18 because he also purchased raw materials, right? On that he paid GST. So this 50 included GST. So that has been adjusted here. So 18 minus GST on raw materials. Okay. So the net amount 10.4 he should pay. Okay. Now listen. These were the cash outflows originally. Now this is also getting added 10.4. So his cash outflow is going to be 90.4. Of course, he funded 80 out of it and he is trying to get back that money by way of a bank funding. So the overall cash outflow with regard to the single transaction is 90.4. Now let's look into two different assessment scenarios. Scenario 1, receivables include GST. Scenario 2, receivables exclude GST. So when receivables include GST, it is 118. When it is excluded, it is only 100. If this entire 118 is considered, then margin at the rate of 25% will be applied on this 118, which works out to 29.5. It means 118 minus 29.5. That particular borrower is eligible for 88.5. This is including GST. Scenario 2 is excluding GST. 100 is the receivable, 25% margin works out to 25. So 100 minus 25, the eligible bank finance is 75 only. So here it is 88.5, here it is 75. Now let's do an analysis. Look at the scenario 1 funding where the receivables include GST. We already know the outflow is 90.4. Okay, that is the cash outflow. And what is the eligible finance, which is 88.5, which comes very close to the outflow. So now we may be wondering how he will manage this 1.5. He can manage this 1.5 very well because he was asked to bring in a margin of 29.5, and here the gap is only 1.5. This 1.5 gap can be easily funded through the margin of 29.5. Okay. But scenario 2, which is excluding GST, here also the cash outflow is 90.4, whereas the eligible bank finance, what we worked out is only 75. So now it appears there is a gap of 15.4. How he will manage this gap of 50.4? That can be managed because he is asked to bring in a margin of 25. So 15.4 out of 25 is very much manageable. So which scenario is considered as more ideal? Is it scenario 1 or scenario 2? In scenario 1, he's been funded 88.5, which is very close to cash outflow, of course, but he's also asked to bring in a margin, right? He's also asked to bring in a margin of 29.50. So this 88.5 plus 29.50, of course, that makes 118. And the thing is, his outflows are only 90.4. Sorry, here I have written as 5. 90.4. So 90.4 minus 29.5. If you look at the gap, it works out to 60.90, and he's been funded with 88.5. It means there is a possibility he will land in excess financing, and excess financing is disastrous. Whereas in this scenario, 90.4 is the outflow. He is asked to manage a margin of 25. So 90.4 minus 25 works out to 65.4, and he's been funded with 75. Okay, this is comparatively better than scenario 1. So that's why most of the banks, they go for receivable funding by excluding GST.
Thank you so much. We have come to the end of this webinar, and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you.
It is this Credit and Financial Analysis Mastery course, exclusively designed for bankers and for those who want to have bankers' point of view. This is a course which we have developed after a detailed analysis, a thorough discussion with several hundreds of bankers and finance professionals. We have identified what is their exact requirement when it comes to SME and corporate credit and financial analysis. In this mastery bundle, I'm going to give you access to various courses. To start with, we have course number 1, Basics of Credit Analysis. In this course, we have explained the basics of credit analysis through various sections, section 1 to 9. Next comes course number 2, that is how to read balance sheet. In this course, we have explained what is balance sheet, how to read them, how to approach them by using real life financial statements. Then comes course number 3, how to do financial ratio analysis like a banker. In this course, we have explained all critical ratios that are analyzed by the bankers, and we have also explained through case studies. Then we have course number 4, how to do cash flow analysis. So through this course, you will understand what is cash flow analysis, how to do a typical cash flow analysis. We have used case studies, and reference to Ind AS is also included in this course. Then we have course number 5, that is how to do fund flow analysis. This is a critical financial analysis tool, and in this course you will learn what is fund flow statement, how to analyze them from banker's angle, how to prepare fund flow statement from academic angle as well. So overall 5 courses, each 1499. So aggregate price should be 7495, but you are not going to pay that. For you it's just rupees 2499 for 1 year access, or rupees 4999 for lifetime access. And it is not yet over, you have some more bonus. Bonus is course number 6, how to carry out credit risk rating for non-trading entities. These are all the topics covered in this course. Then course number 7, it is how to carry out credit risk rating for trading entities. Not yet over, you also have access to course number 8, that is how to prepare CMA report for bank loans. It's a comprehensive course which will run for 8 plus 5 hours, and you will learn entire CMA report preparation process. And course number 9, how to prepare cash budget for bank loans. Course number 10, how to assess fund-based working capital. So in this course you will understand what is working capital, what are working capital credit facilities, and how to assess them, what are the key ratios that are related to working capital, and what are the additional key analysis that will be done by bankers on working capital matters. You will get a comprehensive understanding of cash credit, export finance, and there are certain on-demand videos as well. So 5 plus 5, 10 courses of value close to 15,000 rupees, but you are going to get it for 1 year access rupees 2499, lifetime access rupees 4999. Not yet over. You are going to get access to the 11th course, how to assess non-fund based credit facility. So in this course you will learn about letter of credit, bank guarantee, its assessment as well. Then comes course number 12, how to do term loan appraisal and assessment, because it's a complex process with a lot many technicalities. So this course covers all in detail. And course number 13, basic elements of loan proposal. So how a typical loan proposal will be, what are the basic elements that are covered in this course. And we have course number 14, case study on credit analysis. Various case studies based on practical experience and discussion with various bankers and finance professionals are included in this course. And course number 15, this is about collateral securities, where you get knowledge about collateral securities. So overall it's 15 courses of value close to 22,485. It's 1,000 plus lectures. You can subscribe for 1 year access or lifetime access as you wish. These are all pre-recorded courses, so you can access them anytime as per your convenience. You can access them in mobile app or desktop, and for you the price is not 22,485, it is rather 2,499 for 1 year access or 4,999 for lifetime access. You can check the link in description, where without using any discount coupon code you can enroll at this discounted price, because it's a discount applied link. And not yet over, you are also eligible for some more bonus. The bonus is access to various ebooks and e-resources. You are going to get access to various financial ratios ebooks, financial management related ebooks. You will get access to financial analysis related ebooks, credit analysis ebooks. Not yet over, you will also get access to other resources like test series, templates, audiobooks, video books, career guidance material, and a bonus resource. Check the link in description and enroll now.